Hey, Dillon Wright here. Hope you're doing well. Today I want to talk about cash flow and its importance to your small business. The phrase "cash is king" has been used since I can remember, and based on a Wikipedia search, it apparently throughout history has been used to describe a number of situations and circumstances for various reasons, but I certainly can attest to its importance, to its accuracy in describing the importance of cash flow to the overall health of small business. And the bottom line is that cash flow is vital to any business, big or small, but it's especially important to small businesses as they have limited or finite resources, limited access to capital. So since it's so important, effectively managing the small business, your business's cash flow is equally important. Which brings me really to the gist of this post today, which really I'm summarizing what I consider to be the best practices for small business management of cash flow. Let's start off with the first practice that I consider really absolutely mandatory, and that is utilizing just a basic accounting software package. Um, just gonna say CPU software. For example, QuickBooks, Quicken, Peachtree. Look, guys, I've been doing this stuff, tax returns and accounting and so forth, for long enough where I've seen and been given, the good old shoebox with receipts and a freaking, you know, checkbook as big as an encyclopedia. And that system can work, but let's be honest, it's just there's better ways out there to do it. And really managing cash flow it's important, really one of the most important aspects of running a small business and surviving as a small business owner. So you give yourself a fighting chance, and use some of these basic software packages out there. Like I mentioned, QuickBooks, Quicken, Peachtree is another one. These things are easy to use, they're user friendly, relatively, uh, cheap. They're cost efficient and cost effective. Excuse me. And it's just they're really just a must. You got to start there. Right? I mean, if you can, they'll provide quick and easy access to reports that are really mandatory. I consider to running your business, and so let's start there. But the next practice that is required to manage your cash flow is routine posting of transactions and monitoring of your activity regularly. So, first step, like I said, let's get the basic accounting software package. Next step, you got the accounting software, that's great. But you got to go the next step, and that is entering in your transactions regularly. Because you can go and have the software, but if you're not entering your transactions, your cash in, cash out transactions, the software does you no good. So, if you go, what you should do, what I recommend doing is, at least weekly or bi-weekly, you pull up your online activity of your bank transactions. Make sure each one of them, cash in, cash out, is entered into your accounting software so that your books matches what the bank shows as far as cash in and cash out. If you've gotten all the transactions entered, then really all you got to worry about and make sure is that they're coded correctly. For example, your cash receipts are appropriately classified as income or a loan or a contribution of capital, and that your expenditures, cash disbursements are appropriately coded as expenses or capital assets such as equipment and so forth. So, which leads us into the next step of forecasting cash receipts and disbursements routinely. All right, so let me get this one up here first. Let's see, two. You're going to just say post transactions. All right, so you got this accounting software. You got you're posting your transactions on a regular basis, weekly or bi-weekly. Leads us into, let's see, forecast. Forecasting your your cash receipts and disbursements that are coming in the next week or two is it's important, really, for because you got to know what you've got coming in the next week or two, and versus what you got to pay out in the next week or two. Because this is going to give you an idea of, oh shoot, I'm about to run short. I need to make some kind of, I need to make up for this shortage I know that I'm going to have because I've got to pay these bills and I don't have this, I'm not going to have sufficient income coming in to pay for them, so I better inject some cash out of my own pocket into the business to cover that difference, or I better borrow some money from the bank or from a private investor, friend or family member, whoever, whatever, you got to do. But really, to do this effectively, the forecasting, the primary things that you need to know and have is, okay, what's my cash? How much cash do I have in the bank right now, today? And then, second of all, you need to look into your accounts receivable. What are my customers? What work have I already completed and haven't yet been paid, but I know I'm going to get paid for real soon? So what are my receivables that are going to be coming due? I'm going to get paid in cash here in the next couple of weeks. And third, you need to know, okay, vendor bills that have come in the last week or so, but I haven't yet paid them, but I know I'm going to have to pay them in the next couple of weeks. And then lastly, if you have any payroll, or payroll related taxes, that's a routine thing that, you should have a good feel for after you've been in business for a few months. And so you take those four things: your cash that you have in the bank currently, your receivables that you're going to be converting into cash, real soon, your vendor bills that you're going to have to pay out in cash soon, and then any payroll and related taxes that get paid out, on whatever basis you're paying them out, monthly, semi-monthly, so forth. So with that information, you can come up with a forecast, which is, okay, I've got this much in the bank today. I know I'm going to be getting X amount from customers in the next week or two, and then, but I know I'm going to have to pay out X amount of dollars for my vendor bills over the next week or two, and then of course I'm going to have to also pay out the payroll and the related taxes. After you do those, you've got those four factors, then okay, I've got X amount cash surplus, which, hopefully that is what you're going to have, because then that means you're going to have enough cash, to cover your overhead basically. And if you got a deficit, it's just a scenario where, okay, I better come up with something to make up this difference. Which really leads us into the last practice, that best practice that I want to go over, and that is, you need, really ultimately, you need to have a goal of establishing some source of working capital, and by that mean I'm referring to like setting up kind of an emergency fund where you're able to save money that the business you're able to save cash that the business has generated over time, and kind of got it set aside in a money market account or a savings account or something to that effect. Or it can be in the form of a line of credit with a bank, working line of credit, where basically that's an arrangement where, okay, I can go borrow money from the bank in whatever increments, denominations that I see fit for a short amount of time, and then I'm gonna turn back around and pay them back. And generally, those relations, that kind of arrangement is set up to where monthly, the installments that are due monthly to the bank is just the interest on the principal borrowed, with the outstanding loan balance due at the end of the term, which is generally 1 year. And then lastly would be capital contributions from yourself, the business owner, or I guess if you had an arrangement where you're borrowing from a private investor, or friend, or family member, that could also be a source of working capital to make up for, and also these sources of working capital really, I didn't mention this, that comes into play primarily really when you're at some point your business is going to experience a cash crunch. And I don't mean a cash deficit, which is what we just talked about, where you're looking at your current cash and what you got coming in and out in the next couple of weeks. The cash crunch is really more of an extraordinary circumstance that's beyond your control, that kind of blindsides you. For example, you lose a major customer just kind of out of nowhere, or all of a sudden something dramatic happens in your local economy, and it takes a dip, turn for the worst. This having with those kind of things are going to happen from time to time, and to be prepared to ride that out, ride those storms out, your business needs to have some kind of access to working capital. And like I said again, it could be in the form of a savings or money market account, which is made up of cash and funds that you've saved up through earnings of the business over time, or it could be in the form of a line of credit with the bank where you can pull from and pay back as needed, or it can be in the form of capital contributions or funds borrowed from private investor, capital contributions that you put up to the business yourself. So that's really just a quick little rundown of the the four really what I consider best practices of managing your small business's cash flow. I mean, in summary, I have how I would describe and what I believe that you need to successfully manage your business's cash flow is you need to have a detailed knowledge, for starters, a detailed knowledge of your business's finances. And that kind of goes back to what I was talking about, where okay, I've done this work for these clients and I haven't gotten paid yet, but I know I'm going to get paid in X amount of time, and it's predictable, or you at least have a general idea of when it's going to come in. And furthermore, money going out, vendor bills, I know I've got this coming due on this date, and having that detailed knowledge of your business's finances is it's mandatory to be able to manage cash flow, because it affects money coming in and coming out. Next would be you need to give thoughtful planning to this whole process of managing cash flow, because that's really what all this is planning, short, intermediate, long term future in the future for your business's cash flow needs. Because if you don't, you're going to get blindsided, and then you get blindsided with the cash flow problem. You're going to shut your doors. You're going to be going out of business. And lastly, the ability to adapt to unexpected changes in the marketplace, which is kind of what I was getting at in this last step. Let me write it down of establish working capital, WC source, or source is. And like I mentioned, that generally comes in the form of money that you saved up, working line of credit with the bank, or capital contributions you put up yourself. And having this in place can provide you the flexibility to adapt to, sudden and or dramatic events that occur beyond your control in the marketplace. Appreciate y'all joining me today. Thanks. Have a great day.